speak about this like committee. What are they? Is they're supposed to like monitor oil profits? What's the goal of this thing?
It's really detailed. So I read the bill. I have to read it again probably several times, but it goes into tracking, the manifests to in and out of the refinery. And of course they track volumes and whatnot, but tracking, really tracking pricing and monitoring. There's a quote unquote mystery surcharge of, they say, 50 cents. They being Sacramento and some other folks studying this. So they're trying to monitor every step of where the refinery is making gross margins, net margins, a bunch of reporting. And they already do this on emissions and volumes, like I said, but really looking at the profit margins and even the contracts that they're executing. So there's been some pushback from refineries saying, hey, this is going to come back as collusion against us if we're starting to kind of. There's only 11 refineries in
Yeah.
California, so they can't really start trading all this sensitive information and expect to maintain a competitive market. What's missing from the market is the competition from the local barrel. So since Gavin Newsom's come in, we've lost 65 million barrels a year of in-state production. That's 180,000 barrels a day coming offline. Meanwhile, we're converting a lot of refinery capacity to biodiesel. So you're getting, jet fuel and gasoline refinery capacity shrinking. And it's like a double-edged, double whammy against, the consumer. Everything's getting pricier and more expensive and less competitive. And so this committee is going to identify these things, which on the one hand, I'm like, well, maybe that's good because they'll uncover all these, you know, misconceptions about the market that, the local producer is gouging people or the local producer is to blame. But they'll spin it in a way that's against big bad oil. And it's sad. It's really sad. It's just going to cost people a lot more money to go places.
For sure. And if you, like you mentioned earlier, knowing the midstream, downstream, and the marketing space, more so on the gas side, but we help our clients market the oil as well. I mean, these are typically highly competitive, low margin type of offerings that these companies have because if they
Mm-hmm.
weren't, then they wouldn't be competitive. Oil refineries have to go out and buy the barrels. Barrels a lot of times are trucked in or put into a pipe. It's competitive. If you're a
Right.
producer, you're going to bid it out and you're going to find whoever's giving you the best price. If Sunoco is better than Phillips 66 on the refinery, you're going to sell it to Sunoco and you're going to
Right.
bid it out on a monthly or a 6-month deal. And it matters to these producers. Most guys on the oil side, a lot of them, unless maybe it's on pipe, it's a long haul deal, long term deal. But a lot of
Mm-hmm.
these deals are month to month, 6-month deals, maybe a year. So
Right.
it's a competitively priced market. And if you're not competitively pricing what you're purchasing the barrels for, you're not going to get the feedstock that you need. So
Mm-hmm.
it's almost like a basic lack of understanding of how like business or markets even work. It's like, what do they think that all the refineries and all the producers are somehow getting together in some back alley somewhere,
Right.
like negotiating, like, oh,
Right.
we're going to stick it to the consumers. It's like,
Yeah.
no, they're not. They're all interested in their self interest. They all want the best deal for themselves. And that's the beauty of markets is that they balance because everybody cares about themselves, which means they're out for the best deal for themselves, which means it's going to be competitive. And I just don't see a lot of this like, whatever price gouging going
No.
on because that's not how business works.
No, it's exactly right. It's not how business works, and it's not a coincidence that OPEC announced production cuts last week, and now the price is going up here in California because 60% of our crude comes via foreign production and another 15% from Alaska. So when OPEC moves the production number, that moves our market. It's not necessarily the big refineries in California. They're paying a Brent a Brent price. They're paying an international price to get that feedstock. And the only competition to the Brent price is the local production. That's it. That's the only competitive force that's going to compete against the Brent barrel. And to your point, it's tight margins, it's contracts that are negotiated, and there really isn't some level of murkiness where the refineries are making a lot of profit. They're just looking at, hey, Q3 of 2022 they made $60 billion. Well, yeah, because prices jumped to $120 briefly and the war was hitting and all that, but go look back at the blended whatever 5 to 8 years for the whole return to tell me if they're really gouging the consumer. And I bet you the average returns are probably in line with any other industry.